let's talk about your money. We do it pretty often with Nick Hopwood, certified financial planner, founder at Peak Wealth. Peak Wealth is independent, unbiased, and a fiduciary. So, you know, Nick's advice is always going to be in your best interest. If you need a second opinion, well, there's always Nick Hopwood. All right, Nick, welcome back to the program. Glad to have you here. We got the rate cut of 50 basis points, a full 0.5% cut last week, a little bigger than, well, it's what I said was going to happen, but I was in the minority. I won that little over-under bet. What do you make of it?
Well, the first thing that we have to be aware of is what are the effects, right? So, you know, the Fed is saying jobs are getting a little more scarce and inflation is looking a little better. So it's time to cut rates. So what does that mean for you? It means that your money market rates are immediately going down by 0.5%. And we're also seeing the yields across the fixed income spectrum coming down as well. So when it comes to longer term investments, it might be time to lock in those higher yields before they continue dropping.
Fair enough. All right, so we'll keep an eye on that. Now, you had some things you wanted to talk to the folks about today. And one of those is planning for retirement when it comes to taxation. Now, what worries me is if the people on the left win this election, taxes will be different. A lot of different taxes. But we've got, for the folks that are following on the stream, they can see it. But for the folks that cannot see it, explain what you're concerned about here.
Well, this is more of an opportunity, Steve, rather than a concern. And I think that the tax structure for early retirees would be similar with either administration. But this chart does an excellent job detailing the tax planning opportunity between the timing of your last paycheck and when your Social Security starts. So that red circle there, you can see if you are not showing W-2 income and you're not showing any Social Security income, and you have the opportunity to live off savings or a joint brokerage account, you're going to be in an opportunity to pay almost zero taxes during that window. Now, if you have IRA money, that's different. I'm talking about non-IRA money to live off of. And the real opportunity is to be able to get on the Obamacare subsidies if you're under age 65, which could be worth $1,000 or $2,000 a month in subsidies. The other opportunity is to do Roth conversions in a very low bracket. So if you can take money out of your IRA at a 12% rate, you want to do that absolutely every time.
Now, I'm looking at, as you explain, this post-retirement tax planning valley, it's not like a blip. It's like 3, 4, 5 years of little or no taxes. I mean, that's pretty remarkable what I'm seeing on if I'm reading this right.
You are. So imagine that you retire before 65, let's say 62, and you want to delay Social Security. Okay.
All right.
Maybe you want to delay till your normal retirement age of 67, or maybe even ramp it up to 70. That could be 5 to 7 years where you can, you know, manipulate the system and try and pay the 12% tax bracket for your IRA withdrawals.
Isn't that something? Next time around, we're going to sit here and debate the idea of whether you should take the money at 62, 65, 70. It's a conversation that goes back and forth. But let's talk about the next thing you're talking about here, health insurance, inflation, a big expense to families, huge expense. How do you navigate this?
Yeah, to be honest, it's a nightmare, okay? So you see this chart over the past 24 years, health insurance has gone up 314% compared to the normal CPI of 83%. You know, 83% is bad enough, right? But we're looking at more than 3 times the growth rate for your health insurance.
So just so we understand this, 314% is the increase of health premiums. Health insurance premiums since 1999, they've gone up 314%. That's just jaw-dropping. I mean, that's a budget buster right there. Go on.
And Steve, it's even worse because if you recall your health plan back in 1999, you didn't have these $13,000 deductibles, right? You had like a $500 out of pocket, and that was it. So now we have 314% higher premiums and thousands of percent of higher deductibles. So it's really a double whammy. And so when we get to that age 62 and we're contemplating early retirement, the premiums could be over $1,000 a month per person, in which case you really have to plan ahead. Okay, if you get the pink slip at age 62 and you haven't planned on the health insurance aspect, it can be a real problem. But if you do that, if you go back to that first chart and think about the tax planning valley that the chart illustrated, you have an opportunity to show the IRS low income during those years, which can then qualify you for a monster Obamacare subsidy. Now, you might not be a fan of Obamacare, but if you're sitting here at age 62 and the government is offering you a $1,000 or $2,000 per month subsidy, you should probably take it.
You might just want to do that. I agree with that. One last thing I want to get to here. We've only got about a minute and a half, Nick, but you sent this to me, and I find this fascinating just because I think that we're in a place where a recession is not out of the realm of possibilities here. We'll see what happens in the next few months, regardless of who's elected. But the number of 401k millionaires and IRA millionaires has come back. But what surprises me here, 45 million IRAs in this country and 401ks, 45 million people have those things. Only about 1 million people total have $1 million or more in these accounts. That surprises me. Or is this right?
Steve, to be fair, this is only the Fidelity data. So Schwab is twice as big as Fidelity. You have other custodians as well. So this would not be all inclusive, but the chart shows you that now, today, there are more Fidelity millionaires than any time in the past. And one thing that I think is interesting as a read from here, if you look at the blue line or the purple line versus the blue line, the 401k millionaires have been growing versus the IRA millionaires. And why would that be? I would argue that the reason why the 401k has more millionaires is because during 22, when you continued adding to your portfolio every paycheck, you're buying in on this 25% drop.
Cheap, yeah.
Now it's worth more.
Buying it in as a bargain. I got to leave it right there. PeakWM.com. I want to get this in. PeakWM.com. The QR code for people watching is on your screen. You can get with Nick and get a second opinion. Nick, thank you as